Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And thank you again to every listener that submits any questions and feedback. It's really great to actually have a little bit of a two-way conversation with you guys. So let's get into some questions. And this week we'll start with a question from Philip. Philip writes, I've got a question about debt recycling. There's a lot of information around structuring a loan to do this. There is little information around constructing the portfolio to achieve that. That is a high dividend, good growth approach. Do you have any examples of principles of constructing a share portfolio using debt recycling? So the idea around debt recycling is that you borrow against the equity of your home. And sometimes people sort of say, well, or some of the examples I should say on the internet is like you've got a whole bunch of cash in your offset accounts. And the argument is, why don't you go and put that into your home loan and redraw it? Well, you wouldn't redraw it because then you're mixing purposes, but go and get a new loan as a result of you repaying your home loan down because you've got a little bit more equity in your property, and use that debt to go and invest in the share market, which is then going to give you more income because you got that investment income, and that's somehow going to help you repay your home loan faster. That's true when interest rates were really low. When interest rates were 2% and you were earning maybe 3 to 5% off your investments, of course, from a cash flow perspective, you're in front. Obviously today, now interest rates are much higher than that. You're going to pay somewhere between 6 and 7% to borrow to invest, and probably not going to get 6 to 7% in terms of income. So that means if I go and borrow to invest in the share market, I'm actually going to be worse off, not better off from a cash flow perspective in terms of, helping me repay non-tax deductible debt or home loan debt. What you could do is say, okay, well, Stuart, can you just go and skew towards a higher income, like maximize income? Would that work? Well, you could use VHY, for example, which is Vanguard's high yield fund, which I think is probably the best sort of Aussie high yield share fund if you're sort of going for an income equity strategy, which is really, I'm investing in equities mainly for the income. You've got to be careful there because, of course, you got the volatility still of shares. So whilst you're after the income, the market could crash and that's going to affect your income relative to the value. But putting that aside, even then you'd be struggling to do it. So these debt recycling strategies, I think, are more around selling product than actually a fundamentally sound strategy. It's not necessarily going to help you repay your home loan sooner. The only way it can do that is if you borrow to invest and borrow the interest cost, the deductible interest cost, and then let the investment income go into your home loan. Now, you could possibly do that, or it's relatively aggressive from a taxation perspective. It's called capitalizing interest, and it used to be more popular when lines of credit used to be more popular. So a line of credit is like a little bit like a credit card, doesn't have a loan term, doesn't have minimum repayments, which means that the interest is just added to the loan and it just compounds, which can work as a strategy, but it's really then dependent on investment returns and not something that I'm really in love with. So I've spoken about debt recycling as a strategy previously. Now there's an alternate to debt recycling, which some self-employed people can use around funding debt payments. That's distinctly different. We can, that's certainly a good strategy, but not something that I can talk about on this podcast because the law prohibits me from, talking about taxation strategies like that. Otherwise, I would be accused of running an investment or tax scheme, I should say, which would be caught in the anti-avoidance provisions of the law. So the law is worded in a way that sort of prevents me from talking about all the tax saving strategies we might otherwise do so. Now, the next question is from Alex. And, I promised to everyone, if you send a question, I'll answer it. I'm not really going to answer Alex's question. Alex's question relates to what is called an untaxed super fund, which is, there aren't many around. Weststate in WA, and it's part of GESB or GESB, if you like that's how they call the acronym. So it's a WA public service fund, is what's called an untaxed super fund. Untaxed super fund means that when you make a contribution, you don't pay any contributions tax. It gets invested, they'll take the contributions tax that you owe when you take the benefit. They're really advantageous, of course, because you avoid that 15% contribution tax and you can invest the gross contribution now and then pay the tax in 20 years' time. But they have changed the laws in terms of capping the amount of contributions that you can make. So anyway, Alex has a question regarding that. And Alex, what I would say is, why don't you get in touch with the fund? A lot of funds have, particularly defined benefit funds or untaxed funds. They will have a mechanism where they can provide advice to members that are going to be specific to the rules of that fund. I'm not going to jump into it now, but it is kind of complex. I have looked at it before for another client, but I might just sort of leave it there. I don't want to get too specific on this podcast as it gets a little bit boring for the people that it doesn't apply to, which is the vast majority of listeners. Okay, next question is from Corey, and a really interesting one. Corey writes, my wife and I have $450,000 owing on our home loan, and the home is worth $800,000. So not enough savings for a deposit for an investment property, so we'd need to draw from the equity. Doing some research and numbers, it looks like if we bought a residential property worth $700,000, it would be costing us quite a lot per week. We could purchase a commercial property for about the same amount, but it would net return about $15,000 per year. What are your thoughts on commercial property as a wealth building tool? Is there something I'm missing? I'd love to hear your thoughts. Okay, great question, Corey. Well, firstly, don't worry about saving a cash deposit for an investment property. It should always be funded from equity. Actually, I should be careful. I shouldn't say it should always be funded by equity from property, but that's certainly the way I would approach it. There would be no need to put in cash towards an investment when you have a non-tax deductible debt. All your cash should go towards repaying or offsetting your non-tax deductible loan and just use the equity in property to invest. So let's get back to the original question though, which is kind of commercial property versus residential property. You've said, Corey, that you've got an $800,000 home and $450,000 loan. I'm just going to assume that you're relatively young. You're sort of starting out on your journey in terms of building wealth. And so, you've got a long way to get to retirement, and your goal is really to build your asset base. It's not really about income at this stage, which, it's not always about income necessarily, but income starts to become a little bit more important sometimes as we get closer to retirement. So I'm going to assume you're young and you've got plenty of runway before you are ready for retirement. So then what we've got to think about is what asset is going to give us the highest return over the next, let's say, 30 years, and what are the components of those returns. Now, sometimes when people look at commercial property, they go, look at the high yield, like you've mentioned, Corey, in your numbers, you have 15,000 positive cash flow. Whereas you said a $700,000 residential investment property would cost you quite a lot each week. It's true. It's probably going to cost you, I don't know, maybe $15,000, $20,000 after tax. So there's a huge gap between losing $15,000 or costing $15,000 and gaining $15,000, $30,000 gap, right? So it's substantial. The only way one of the advantages of commercial property is that the tenant pays for most of the outgoings. So not only is the starting yield a little bit higher, but also you don't have to wear those expenses associated with running the property. So I certainly acknowledge that. But the starting yield is certainly higher, and I haven't done the numbers, but to achieve an outcome like that, you might be thinking you're going to get a 6% yield on a commercial property or maybe it's more, in order to achieve an income return of $15,000 plus. Well, if you get a 6% yield and you're going to assume you're going to get a 6% yield over the next 30 years, what do you think you're going to get in capital growth? My argument would be you can't expect any more than, say, 2 to 4% capital growth, because that's going to give you a total return of 8 to 10%. Now, it could be that over the next 30 years, this is such a great asset, is going to give you more than 8 to 10% total return over that period of time. It could be, right? That it does happen. I wouldn't build an investment strategy on it. Anything more than 10% compounding over a long period of time, I think is a pretty full return and doesn't provide really for any volatility or any change in distribution of returns over that period of time. Whereas if you look at the residential property, you go, okay, I'm going to get maybe 3% yield. in terms of rental income. And there's a whole bunch of expenses and then interest, and that's why it's costing me a lot of money each week or month. But what is your capital growth as a result of that? Well, if it's 3% and we're going to compare apples with apples, then I'm going, that is the commercial property, well, then I'm going to get a return of, say, 5 to 7%, which again gives me a total return of 8 to 10%. And so if we're comparing apples with apples, what we're really comparing is a 5 to 7% capital growth rate to a 2 to 4% capital growth rate. And I can say over a 30-year period, that difference in capital growth rate will be substantial. And I think it's a good lesson for people listening in terms of prioritizing shorter term returns at the expense of longer term returns. And the answer is that the people that, have the foresight to make good long-term quality decisions, and property is certainly a really good long-term decision, that they'll be well rewarded for it. So let me just put some numbers around that. A 3% compounding capital growth rate on 700,000 over 30 years is 1.7 million in 30 years' time. That's in future dollars. At 6%, which is the residential property, it's $4 million. So we've got a gap there of $2.3 million in future value, right? So it's not 2.3 today. But there's your answer. The answer is you are rewarded for delayed gratification. And perhaps the commercial property isn't going to necessarily deliver those returns. The only way it can beat it is if you get a 6% yield and you get a 6% capital growth rate. And it's possible you'll get that for a period of time, maybe 4 years, 5 years, something like that. But it's unlikely, still possible, just unlikely you'll get it for a 30-year period. And that's why investing is simple but not easy. Like, it's simple because it's simple, we can all understand that math, but it's not easy because we have a natural inclination to try and bank returns earlier on in the investment cycle as much as possible, rather than prioritize, where we might be 30 years from now. And that's particularly the case when we're younger. As we get older, that's easier to do, or it feels easier to do, I can certainly say. But certainly when I was in my 20s, I would love to bank a $15,000 income as opposed to losing money on investment property that I will gain from in 30 years' time. But, there's that saying that, I think it was Buffett, someone sitting in the shade because someone planted a tree 30 years ago. It's the same sort of thing. But great question, Corey, and thanks very much for submitting it. Okay, next question, really interesting one, is from Mitchell. So Mitchell's question is two-part. The first one is that I'm in the process of buying a property with my partner. Firstly, would you recommend organising a building and pest inspection for a brand new build, given it's covered by a 7-year new building warranty? Well, firstly, if that property is for an investment purpose, I would be very careful about buying a new build property. Typically, new build properties are in locations where the supply of vacant land is abundant. It's certainly not finite, and that's going to have a long-term impact, not necessarily in the short term, on the value of the underlying land value. But let's assume you're buying it for a primary place of residence, in which case we don't necessarily need to prioritize those financial considerations, although I still would personally. It would depend, if I was buying a brand new build, it really depend on the reputation of the builder, I think, and my assessment of the reputation of the builder. But I have many years ago, well before I knew what I know today, I did buy an apartment off the plan. We're talking about sort of 25 years ago now. Actually worked out well for me from a financial perspective. I sold it as soon as I realized it was a mistake and made some money out of it. Not an excuse, it was a mistake right from the beginning. In that situation, I ordered a building and pest inspection just because I wanted to know before I settled on that property that there weren't any major defects. And I think, a building inspection costs you $500 to $700. Even if it's a waste so they don't find anything, I still think it gives me peace of mind. So I'd be inclined to do it. I would probably not do it if I was super certain that the quality of the build was there, and in fact it would be a waste of money. So I don't think there's much downside to that. And prime property, it's a huge expense, right? So I think relative to the expense, the cost of a building and pest inspection is nothing. Okay, second part of Mitchell's question is, what are the pros and cons of tenants in common versus joint tenancy from a ownership structure? For context, my taxable income is approximately 3 to 4 times that of my partner's, and she's likely to undergo an extended period of maternity leave. So since you're talking about tenants in common and joint tenants, Mitchell, maybe answer the first question is maybe it is an investment property. And if it is, just don't buy something that's new. You can go back onto my blog. I've written many, many times about buying off the plan. In fact, if you just Google Pro Solution off the plan, they'll bring up the blog topics that I've written about on that. So anyway, so just for listeners, there's two ways we can own a property. Joint tenants, which is a really common and probably the most common way, which means, typically two spouses go and buy a home. They're typically owned as joint tenants. And with joint tenants, what happens when one person passes away? The ownership automatically transfers to the remaining joint tenants. So my wife and I own our home as joint tenants. If I pass away, she's immediately the owner. That means that property doesn't go into my estate. It's not subject to my will. It automatically transfers to my wife. So if you want to keep assets outside of your estate, in case you're worried about it being challenged and so forth, and keep it really simple, owning property as joint tenants is kind of the way to go. Tenants in common is an alternative ownership structure. With joint tenants, the first one I spoke about, it's assumed that there's equal ownership between all the tenants. Right, so if three people own one property, it's assumed they all own 1/3 of that property. With tenants in common, you can actually ascribe a certain ownership percentage. So for example, my wife could own 80%, I own 20%. So in what circumstances would you choose tenants in common over joint tenants? There's a few of them. Okay, so typically for our clients, how we would structure an asset is we would rarely have a property solely in one person's name. So let's say we have the husband, he's at home looking after the kids. The wife's a predominant income earner on a very high income. We say to those clients, let's go and buy an investment property. It'd be fully geared. We want the wife to enjoy the negative gearing benefits. Most people listening to this podcast might go, okay, wife own 100% of the investment property. Our view would be we would put 99% of the property in the wife's name and 1% in the husband's name. And the reason for that is that we want to have both spouses on title so that no one can control the property. It's really just an asset protection mechanism. No one can control the property without the other person's authorization. So in a situation where they have a relationship breakdown, the wife can't just go and unilaterally go and sell the property. The husband has some control over the assets. So we use tenants in common quite a lot. Another circumstance where we'd use tenants in common is where we had a client and they wanted to go and buy, or we said, let's go and buy an investment property. And they had some cash, some spare cash to notionally contribute towards that investment. And let's use some round numbers. Say they got $100,000 and we want to go and buy a property for, let's say, $1 million. And let's say the wife didn't have any income and the husband had a very high income, as in Mitchell's situation from his question. In that situation, we would probably put 10% or maybe a little bit more in the wife's name, and then we would put 90% in the husband's name. And we would go and borrow 100% of the total cost of that purchase. So the wife, let's ignore costs, would go and borrow $100,000 and the husband would go and borrow $900,000. We would take their $100,000 of savings and put it in the offset account attached to the wife's debt. So essentially the wife's got a loan of $100,000 and $100,000 in the offset account. There's no interest expense. As a result, the husband's got a loan of $900,000 and all the interest expense is in his name. He's a higher income earner. He can benefit from it. The wife gets 10% of the property's income. Because she's got no other income, she's not going to pay any tax on that. The husband then gets the remaining 90% of the income, but he's essentially got 100% of the family's interest expense. In fact, in that situation, we might even put 20% of the property in the wife's name, and then it ends up being 50% geared, if you like, because she's only borrowed $100,000, or she's only got $100,000 in the offset account. Whatever achieves the better sort of tax benefit. And also sharing that ownership will help in the future as well, if and when we go and sell the property from a capital gains tax perspective. So using tenants in common then allows us to gear each individual owner's portion separately. So we can have the lower income earner's name geared to a lower extent in return for maximizing the gearing for the highest income earner's ownership percentage. The final reason would be estate planning. So if we had a good example might be two friends going buying a property together, you would structure that as tenants in common, because tenants in common, when that tenant dies, if it's owned tenants in common, the ownership goes into their estate. So if you're investing in a property 50-50 with a friend, for example, you would own it tenants in common so that if you passed away, your 50% share of that property goes into your estate, where if you owned it joint tenants, it would naturally pass to your friend, which you may or may not want to do, of course, but probably don't. So great question, Mitchell, around sort of ownership structure and some of the ideas around sort of structuring debt and ownership and taxation consequences and giving yourself flexibility in the future. Okay, next question is from Effie. Effie writes, what I'm doing at the moment is I opened up my own individual account, quoted my own tax file number, and 2 minor accounts with their tax file number with CMC Market, which is an online share trading account. I'm painfully aware that of the minor tax-free threshold, which is really low. I bought around $6,000 in DHHF, which is the Diversified Beta Shares Fund, so that we won't cross the tax-free threshold. I'm also dollar cost averaging buying DHHF under my name in small amounts given the free brokerage for trades under $1,000 with CMC Markets. These brokerage accounts are purely for my kids, and I'm planning on a buy and hold strategy for the next 10 years. I'm not really interested in investment/education bonds given I don't really have a large sum of money to invest. Do you have any suggestions or thoughts on investing for kids? Effie, I think you've done a great job in regards to investing. I mean, the investment bonds, they're marketed around sort of tax savings, but you got to think really carefully about whether those tax savings are going to mean anything to you, because you've just opened 2 minor accounts. Essentially, you've got an informal trust arrangement there, which means that when your kids are 18, you can transfer those assets to them, and that won't trigger any capital gains tax. They will wear the capital gains tax consequences, but when they're adults over 18, them maybe at uni, for instance, they're not going to be earning very much money, so they could sell the assets. They're probably not going to pay any capital gains tax anyway. So the investment bonds notionally or theoretically can save you tax, but the reality is in lots of situations, particularly around these sort of situations, saving for kids, they're not going to pay any tax anyway. So I think you've done a great job there. Sometimes, with my kids, I've created those minor trust accounts, but I quoted my TFN just in case I breached the $416 that a minor individual can earn before they pay, punitive tax rates, about 66% or something like that. So, they're very highly taxed if they earn more than $416. So I've quoted my TFN under those accounts just in case that occurs, and I'll sort of wear the tax burden. I mean, it's nominal compared to the cost of raising kids, of course. So that's my only other suggestion. The other thing you might want to consider, you're investing in DHHF, which is the Diversified Growth Beta Shares product, which I love. I think it's a good product. And if you're going to invest it for the next 10 years, you're going to do really well for your kids. Well done. The thing you might want to think about is actually investing in GHHF, which is the internally geared version of DHHF. And the only reason I would say that, given your current situation, is what that will do is the gearing will reduce the amount of income you'll get from that investment and therefore help you keep under that $416 limit for your kids. And the gearing over the next 10 years will also help with the returns. You smooth it out. I mean, you might be worse off in, say, 2 years, but if we're talking about a 10 plus time horizon, which you are, Effie, then GHHF will actually not only maximize returns, but most likely minimize taxation consequences. And the reason for that is the fund is going to use the investment income to pay for the borrowing expenses, the interest within the fund, and therefore not really distribute much in terms of income. So it's very much a capital growth investment rather than an income investment, which is perfect for your kids because you get that compounding capital growth. But how you've structured it using, online low-cost share trading accounts in minor accounts, which is like an informal trust arrangement, essentially means the kids have the beneficial ownership, and you're just there acting as the guardian or the adult individual to be able to open that account. So good work, Effie, and that's the only suggestions I might have in that situation. Okay, next question is from Shane. Shane writes, myself and my wife earn over $250,000 a year and both eligible or liable to pay Div.293 tax. We are in our mid-40s and have relatively low superannuation balances, both under $200,000 each, with some catch-up concessional contributions to make. We have a positively geared investment property and we're hoping to buy a family home this year. What is your general approach to Div.293 and individuals earning over $250,000? earners. There are sure to be more people that get caught up in this tax bracket as the years go by. Okay, so just as a bit of background, Shane's talking about making concessional contributions. Concessional contributions into super are the contributions that you can claim a tax deduction for. There's an annual cap of $30,000, and that $30,000 includes the mandated employer contributions, often called superannuation guarantee contributions, or SG for short, and you can claim a tax deduction for that. That's fine. If your super balance is under 500,000 at the beginning of the financial year and you haven't utilized that full cap in the previous 5 years, you can bring that forward and use it this year. If you make a concessional contribution, those contributions are tax deductible to you as an individual. So if you're salary sacrificing those contributions, you obviously pay less tax out of your salary. Or if you make personal contributions, you can then put it in your tax return and reduce your tax. When they are received by the super fund, they are taxed at that point, and they're taxed at a flat rate of 15%. All contributions 15%. So if I'm putting 30 grand in and I'm on the highest marginal tax rate, that's going to save me 47%, but I'm going to pay 15% in the super fund, so I'm 32% better off. Okay, once you lodge your tax return, if your adjusted income, so adjusted income is after adding back investment income, all those sorts of things. If your adjusted income is above $250,000, you will have to pay what's called Div.293 tax, which means that if you earn more than $250,000, those concessional contributions will be taxed at 30% as opposed to 15%. The rationale behind this policy, which is only a few years old, 5 years old, something like that, is that higher income earners were getting disproportionately higher benefits from making contributions into super. So you're still better off, right? Because if you don't make that contribution, your income is taxed at 47%. If you make the contribution, you're going to have to pay 2 times 15%, so 30%. So you're 17% better off by making those contributions. And there's really nothing you can do about it. There's no way of avoiding Div.293 tax. The only decision is whether you take it out of super or whether you pay it personally. Because what will happen is once you lodge your tax return, the ATO will actually work out what your adjusted taxable income is for Div.293 purposes. They'll work out whether you owe a debt. And then if you do, after you lodge your tax return, maybe some weeks after, you'll receive a bill for Div.293 tax. And that bill will tell you, you're okay, you can let your super fund pay for it, or you can pay for it personally. So, Shane, the only decision for people that earn more than $250,000 is really whether to pay the Div.293 tax personally or whether to let your super fund pay for it. In terms of making additional concessional contributions and using catch-up concessional contributions, it's still going to save you 17% in tax. It's still going to get more money into an environment that is ultimately going to be tax-free at the end of the day. And in your situation, you said you're in your mid-40s and both your wife and your balance is less than $200,000. So to my mind, you really need to start building that balance. So in your situation, I would be saying, yeah, definitely, if your cash flow position allows, maximize your concessional contributions this year. And if your cash flow and asset position allows, although you said you're going to try and buy a family home, so maybe it doesn't at this point, but certainly use your catch-up concessional contributions. And what I typically advise to people, again, if they're in an adequate financial position, do so, pay the Div.293 tax from your personal resources, thereby, preserving as much money in super as possible. So, that's really the goal, is we can all have up to, as it stands today, $1.9 million. It could be by the middle of next year, it could be up to $2 million tax-free. And we can have that amount each tax-free inside super and not pay any tax. That's a really attractive proposition. If we're going to be self-funded retirees, I would want at least $1.9 million of my wealth inside super. So that's the goal. And Shane, if you're in your mid-40s, you really want to get more money inside super. So we don't like to receive that tax bill, and then it's natural to think, oh my God, I've got this tax bill. Can I avoid paying it? Well, the simple answer is no, unfortunately. You are still 17% better off. And the answer is, try and pay for that personally. But great question, Shane, because we get that question a lot in our business, and it's a really common situation. Okay, I've done 3 weeks in a row now of Q&A. I just wanted to try and get through as many of these questions as possible, but certainly keep them coming in. They're really great, and I hope you enjoy listening to them. I might try and produce a normal case study episode next week, and then we'll get back to some more more Q&A. But thanks so much for listening in. And until next week, bye for now.